Good afternoon. Welcome to Haselwood Auto Group's Health Savings Accounts 101. This is going to be a high-level overview of health savings accounts, the eligibility, how they work, how they can be really beneficial, and how they work in conjunction with your qualified high-deductible health plan. So what are health savings accounts? These are specialized savings accounts that are used specifically with qualified high-deductible health plans. They're powerful tax savings tools that allow you to set aside pre-tax dollars to be used for qualified medical, dental, and vision expenses, either current or in the future. Because health savings accounts are considered tax-favored accounts, the IRS has set some eligibility rules that you have to meet before you can open a health savings account. So first, you have to be enrolled in a qualified high-deductible health plan. The HSAs offered by Haselwood qualify, so there's nothing to worry about there. You cannot be claimed as another person's tax dependent, and you can't have other first dollar health coverage that will help you pay those claims while you're in the deductible period of the qualified high deductible health plan. So those are things like Medicare or TRICARE or other non-qualified high deductible coverage. You can also not be covered by a traditional FSA because general purpose or traditional FSAs pay for medical, dental, or vision expenses. That's considered first dollar coverage. There is an exception to that FSA rule, and that is the limited purpose FSA, because those only cover dental and vision expenses. Now, there are many advantages to health savings accounts. First off, there's triple tax savings. You're going to contribute using pre-tax dollars, so that automatically reduces your taxable income. The funds, while in the account, earn interest, and those accumulate tax-free. And distributions taken for qualified expenses are also tax-free. Now, the account and the funds in it are yours, even if you change plans, employers, or retire. And if you are not enrolled in a qualified high-deductible health plan any longer, you can still use the funds for qualified expenses. You can just no longer contribute to grow those funds. Now, the use it or lose it feature that we're familiar with flexible spending accounts does not apply to health savings accounts. So you never have to worry about using up the dollars by the end of the year or face forfeiture. They just continue to stay there and grow for your future use. And one of my favorites is there's flexibility in the contributions and how you use them. So you get to decide how and when you want to contribute, and where and when to use those funds for qualified expenses. A lot of flexibility there. You may be asking yourself, where exactly are these contributions coming from? Well, you as the employee and the account holder, you're the primary source of those contributions. They will come out through payroll deduction on a pre-tax basis and go right into your account. You get to decide how much. So you can start low and increase your contributions later if you would like, or you can start out high and front load that account and then reduce your contributions. You can decide exactly how much and where and when to stop. Now, family members can also contribute on your behalf, but they will not receive the tax benefits of contributing to a health savings account. Because the account is yours, those benefits are yours. So any contribution that a family member might make for you will go into the account on a post-tax basis, but when you complete your income tax at the end of the year, there'll be an opportunity to make that deduction to receive that pre-tax benefit for those contributions. Now, the IRS does set annual limits. They take a look at them every year and so far have made pretty small little changes, but a little change every year. For 2023, if you are enrolled in individual coverage, you can contribute up to $3,850. If you are covering at least one family member, you can contribute up to $7,750. And these are limits for the 2023 calendar year. If you're 55 or older, the IRS is allowing an additional $1,000 that you can contribute on top of these annual limits to beef up that health savings account contribution and your savings over time. So how does the HSA work? Well, you're going to use your HSA funds to pay your provider bills directly from the HSA, or you can pay for them out of pocket and then reimburse yourself. If you don't have enough in your HSA, then you can pay the claims yourself, or maybe with your favorite mileage card, and you reimburse yourself at a later date. There's no time limit on reimbursement. You'll also have the choice of using funds from your HSA or letting them grow for future expenses. And remember that these accounts are self-managed, so you won't submit claims to a third party. They won't be looking at the claim saying, yep, this is qualified, we'll go ahead and reimburse it. That's going to be up to you. So you're responsible for keeping the records of your qualified expenses and what funds or distributions were taken from the HSA, and of course what is and isn't a qualified expense. Now hopefully you're thinking, wow, this is a pretty cool thing, but you're wondering, is this right for me? Well, qualified high deductible health plans themselves are not for everyone. Are you enrolling by yourself, or are you covering dependents? What kind of medical expenses have you incurred in the last couple of years? That helps you decide, what you can anticipate in the coming year. So enrolling in the qualified high deductible health plan to take advantage of the lower premiums and to have eligibility for an HSA involves looking at your risk tolerance. So before you get too excited about a health savings account, you want to think about what you can expect from that qualified high deductible health plan that you'd have to enroll in first. So claims processed through a qualified high deductible health plan are going to be applied to your deductible first. All in-network preventive claims are paid at 100%, but everything else is going to go to the deductible. So that your office visits, your prescriptions, a trip to the ER, maybe a visit to the hospital. Once your full deductible has been met, then your cost share becomes coinsurance of just 20%. If you're covering family members, then that means you've got a family deductible that you have to meet, and that must be met before your cost share becomes coinsurance. And during that time, you can use your HSA funds to pay for claims or pay them out of pocket. But just know that you will be incurring claims that will all go to your deductible first before they become coinsurance. So here are some things you should be asking yourself if you're considering enrolling in that qualified high deductible health plan and opening a health savings account. So what happens if you have a large claim early in the year before you've built up a balance in the health savings account? Are you prepared for that large claim, either to make payments to a provider, or if it's big enough, whip out that credit card to pay for them? What kind of claims do you anticipate having, and what are the actual costs? With prescriptions, we're so used to paying co-pays that we may not be paying attention to the actual cost of the drug. The amount that's going to be applied to your deductible is that actual cost. So you really want to know what those prescriptions cost. Same thing with office visits. We're used to a copay. Well, office visits can run $130 to maybe $300, and that's the amount that will get applied to your deductible and become your out-of-pocket cost. And you're wondering, well, how do I find out these answers to these questions? Well, talk to your providers. They can certainly tell you what they're going to bill. You can also look at your explanation of benefits, or EOBs. Past EOBs with current providers that we're used to going to see will show you how much they've billed, what was allowed after provider write-off, and then what actually then gets processed and paid. So it's that amount after a provider write-off that's your actual cost of the claim, and that's what's going to go to your deductible first. And then if that full deductible's been met, then you just pay co-insurance on it. So now what? You've been listening to a lot of information whirling around there, hopefully not being confusing. But here's some steps to help you decide. So the first thing you want to do is compare anticipated claims with all of your plan choices. You want to see how what you anticipate happening will be processed by each plan choice you have. So take a look at your PPO plan options. What are the copays? How would expenses pay that are applied to the deductible? Then look at your HSA options. Remember, those expenses other than preventive are going to go to your deductible first in full, and then once the deductibles have met, then you have co-insurance. Step 2, if you're going to be covering any family members, you want to do the same process with them. What are their claims? How have they been paying? What are the actual costs? And then step 3, compare the results between the plans. Which plan results in the highest out-of-pocket expenses? And does that change the outlook on which plan looks better to you? So now you've reached step 4. At this point, hopefully it's really clear which one of the medical plans is your best fit. But if it isn't clear which plan is the right one for you or your family members, that's when you want to look at the benefits of the health savings account. So you're automatically going to save money each pay period just because the premium cost shares are lower for an HSA qualified plan than they are for the traditional PPO. You can take that per pay period cost savings and contribute that to your health savings account and immediately have that money working for you, set aside to pay for any anticipated claims. Now for 2023, remember you can save up to a total of $3,850 if you are enrolling as an individual, or if you have covered one or more family members under your medical plan, then you can contribute that $7,750. All of that's pre-tax, and if you're taking those premium cost savings and putting that in, you've already got a great start towards that annual max. Okay, I want to give you some things to think about to wrap up this webinar. I know that it's been a lot of information. It's probably spinning around in your head, but here are some things to really think about. Don't choose your qualified high deductible health plan options just because of the health savings account. You want to choose a medical plan that works best for you and your family. That's the first priority. The health savings account is a great savings tool, but only if you're already comfortable with a qualified high deductible health plan first. That's critical. You've got 4 great health plans to choose from. There isn't one plan that's better than the other. It just depends on how you use your insurance and what types of claims you have or you're anticipating having. If you're unclear on the differences either between the medical plans or you have questions on health savings accounts, please ask questions. It's really important that you understand your medical plan and how it works. They're all great plans, but they process claims differently. And if you have questions, you do have resources to reach out to make sure you get answers. You can contact your HR team there at Haselwood Auto Group. You can also reach out to Brown & Brown. Stephanie Kuntz is the Senior Account Manager. She's happy to help you with any questions you have. So again, thank you for listening to this webinar. I hope it's been helpful, and have a wonderful day.